First, the disclaimers, which I always have to do. This is not a solicitation to buy or sell any security ever. This is not advice. The results here are provided for general information purposes as a convenience to you. The materials are not a substitute. All right, economic update. All of this has been caused by COVID, right? So before COVID, we were not headed here. Inflation is still the only thing that matters. Only with quotes, because I mean, obviously other things matter. If there's a war, it matters. If a company reports a 300% loss, then that's going to matter. But in general, this is still all driven by inflation, including how bad or if we face a recession. All right, let's talk about inflation, the stuff impacting it. This is the short version. This was the Fed stance 2 quarters ago. All right, so that was the Fed stance 2 quarters ago. I made kind of a pretty big stink about it. If you guys remember, I went on a pretty big sort of a jubilantly excitable tirade. And I said very clearly, I said, if the Fed continues, this is, by the way, this is in October, said if the Fed continues to message hopelessness, the credit markets will oblige. Right? This is now 5 months ago. I said, we need calm, and calm needs to come from a message of, and calm does not come from a message of hopelessness, right? The Fed is getting dangerously close to handing itself its largest failure ever. Okay. Fed stance this quarter. This is from the most recent statement of economic projections, SEP. Rates will be at least 5.1% at the end of 2023. That's from a dot plot. There will be no rate cuts in 2023. 2023 and 24 core inflation will be a little bit higher than they originally projected back in Jackson Hole. Okay. And the bond market, or the futures market, sees it differently. But the bond market has also been wrong. So their bond market is not smarter than the equity market, and it's dangerous to simply assume that the bond market is right. Dangerous. In October of 2021, the bond market was pricing the following. The Fed was going to hike by 30 bips, so one hike. Inflation would be 2% in 2022. Instead, the Fed hiked by over 400 bips. Inflation peaked at 9%. The bond market did not predict inflation. It did not predict rates correctly. So why should we assume that it will do so now? Okay. That doesn't mean it's wrong now, but let us not just say, oh, the bond market knows. The bond market doesn't know anything more than the equity market knows. Just stop it. Here's a chart of the Fed funds futures market from Friday. So from yesterday, this is what the futures market is predicting rates will be at the end of this year. So we know what the Fed forecasts, right? No rate cuts, 5.1%. Here's what it's saying. I know where I'm going to walk through this. Okay, so that's the Fed forecast right there. That Fed forecast, we're going to be in this range. So there's a 1.9% chance. This is the current rate. There's a 12% chance the Fed doesn't, according to the futures market by December, that there's a 12% chance, so let's say a 1 in 8 chance that it's actually just where it is. And that means there's an 86% chance of a rate cut. Okay, and to be even more explicit, there's over a 50% chance for some of these, almost a 60% chance of a 50 basis point rate cut. There's a 25% chance of a 75 basis point cut. Okay. But then all of a sudden we also got this bank's failure thing. So what did the government do? Okay. All right. The Department of the Treasury, the Federal Reserve, and the FDIC collaborated to avert a contagion. And how did they do that? First, they said, okay, everyone who has over all of your money over $250,000, we're going to guarantee it. Okay. Nope. Okay. That's it. We're not going to use taxpayer money for that insurance. We're going to charge the banks, but you're good. Your money's good. Stem the tide. Instead, these 3 entities created something. Well, officially, it's the Fed that created this, but it's the 3 entities created a short-term lending program called the Bank Term Funding Program, BTFP. And so, what is the BTFP? It offers these 1-year loans to banks on more lenient terms and has a $25 billion allocation. Okay, so it allowed banks to use their held to maturity value of government-backed debt. The government said, we're going to take your debt, we're going to take these treasuries or agencies, and we're going to allow you to use that as $100 of collateral. You give it to us, we'll give you $100 of cash, because we know that this is backed by the full faith and credit of the U.S. government. But we're going to do this. This is not indefinitely. That is crucial to understand. It's for a year. Okay, so here, you guys are going to get some cash. We're going to hold your collateral. The collateral is crucially important to the story. Crucially important. It is backed by collateral. Crucially important. It is not for an indefinite period of time. That is crucial to understand. Okay, these are not just little bullet points. By the way, I'll just say again, we could not do this in 2008. The Fed would not have said, oh yeah, we'll guarantee that debt will be worth $100. It was all toxic. Okay, so it's not 2008. So, okay, over here, why is this not quantitative easing? The Fed's balance sheet is rising. Quantitative easing, what is it? Start real basic. Quantitative easing involves the Federal Reserve purchasing bonds. That's a purchase. It's not collateral. It's purchasing bonds, and it's increasing the money supply, right? It's taking bonds onto its balance sheet and sending cash out to the world. Right? Money, remember everyone looked at M2? That's the money supply going up. It is for an indeterminate amount of time, these bond purchases. It's not, they're not going to say we're only going to hold them for a year and then sell them again. No, it's indefinite. And there is no collateralization. There's no collateralization. There's no collateral. So this causes an artificial demand for bond prices. Well, guys, what happens if there's an artificial demand for bond prices? That's what I wanted to show you. Because of bond prices, if there's an artificial demand for bond prices, then yields drop, right? Higher prices for bonds means lower long-term interest rates. So this allows the banks to lend more easily without having them to secure collateral. They don't have to hypothecate anything. So that's the easing part of quantitative easing. Collateral is not required. Rates go down, money into the system goes up, and the banks can lend more easily. That's the easing part of quantitative easing. Crucially, I'll repeat it. Quantitative easing is for an undetermined period of time, and it removes collateral. It removes collateral, it takes bonds out of the open market. Okay, but the BTFP provides loans against collateral for a specific duration, 1 year in this case. Okay, so while QE reduces collateral and duration, it takes collateral off the table, the BTFP bolsters collateral. It's the complete opposite of QE. It creates more collateral. It's for a fixed period of time. Now, why does this impact inflation? First, before I say it impacts inflation, I had to tell you why this matters. So why do small and medium-sized banks matter? Because this is really a small and medium-sized bank problem. JP Morgan's, Bank of America, I'm not even going to say Wells Fargo, Citigroup, they're okay with their duration and their deposits. Okay, this is why it matters. First of all, small and medium-sized banks, these are less than $250 billion in assets. First, 50% of commercial and industrial lending, it's called CNI. If you think that's a big number, hold my beer. 60% of residential real estate lending, 80% of commercial real estate lending is from small and medium-sized banks. I hope you realize that small and medium-sized banks do not have a small impact. It's 45% of consumer lending. Where did I get this data? From none other than Goldie. And this time Goldie put it publicly, so I'm allowed to tell you. Small and medium-sized banks really matter. Using the phrase small and medium-sized it denigrates the importance of this group of banks. Now, why does it impact inflation? First, these banks, which I just showed you, they're pledging collateral to the Fed for cash. They're saying, here's my bonds that I screwed up on. I know in 30 years they'll be worth $100. That's fine, but I bought too early. Rates are going up. Bond prices are going down. So you take it. The Fed said, sure, we'll market at $100. We know we're good for it. It's actually the Treasury. But Fed's like, yeah, we know the Treasury is good for it. We have a good relationship with the Treasury. And the banks are taking that cash, so their cash balances don't fall. Remember that chart I showed you from Ian Shepherdson? Deposits are going down. Uh-oh, we need cash. Okay, I'll tell you what we're going to do. We'll just send our bonds, which are backed by the full faith and credit of the United States Treasury, and we're going to get cash for it, and now we're not going to go bankrupt. Right? That's so cash balances don't fall below the minimum requirements. And they will send the Fed that 6250, remember? Went from 77 to 60. They're going to send that to the Fed, and they're going to get 100 in cash, but they're going to pay it back in a year. It has been collateralized. It has not been taken out of the system. It's not easing. In other words, these banks are borrowing cash from the Fed so they don't go bankrupt. That's what's happening. You can delete everything I just said and have that one bullet point. Banks are borrowing cash from the Fed so they don't go bankrupt. The cash is not going to go toward new loans, I think. That would be crazy if it was. I think it's going to stay on the balance sheet so their stocks don't go to zero. Because when it all comes down to it, the CEOs, they own stock. They need stock to go up. And it's really hard for your stock to go up when there's a Q at the end of your ticker. SIVB stock is not going to go up. It's zero. Same for Signature Bank. Gone. They're going to hold on to the cash. This financial shock is going to alter money flows. Okay? So it's going to direct funds towards safe collateral, like treasuries or held in cash, and large banks. That's where the money's going to go. In contrast, the riskier entities like regional banks, which really, really matter, right? And consumer-related loans driven by the regional banks, right? They could experience reduced money flows. So a credit tightening is expected to occur rapidly. And although a quantitative framework for converting this new contagion risk into interest rate hikes is lacking, there is no playbook. It's never happened before. Some people have suggested it's the equivalent of a 150 basis point rate hike. That's Apollo, and that's kind of someone actually said 200 basis points. Others say maybe it's 50 bips. It's 2 to 8 more hikes just by this event. So we see a shock to the system. But it's exactly what we warned in prior CML Pro webinars. It's a Hawk's process. A tightening will be nearly immediate and long-lasting. Now, I have this issue. I write things and not everybody reads it. But of course you don't. I'm subscribed to a lot of things that I pay for. I pay money for it. I'm going to read all of it. Come on, man. Ain't nobody got time for that. Right? It's not a comment on you. It's us. That's who we are. It's like, fuck, I got to live a life. I got to run a company. You guys got to do whatever you do. And yeah, you pay for stuff and you want to read it when it's important. You're not going to read every word. Come on, nobody is. I really want you to now pay attention to some of the things I'm going to talk about it. And since we've had some trouble with people misunderstanding what I'm saying, I'm going to try a new learning device. 2 things. One is red font. The other is I'm going to take snapshots of things that I've already said. Kind of like a reader, like, oh, he did say that. So I'm going to repeat this. I said, if the Fed continues to message hopelessness, the credit markets will oblige. On our last webinar, I was criticized by some members for criticizing the Fed, and in particular, Neil Kashkari, so hard. I don't think anyone is saying that now. I have hedge funds calling and saying, you nailed it. We didn't really see the hopelessness side of what you're talking about. It's very touchy-feely. It's qualitative. The entire economy is touchy-feely and qualitative. If you believe there's going to be a recession, and I believe there's going to be a recession, and everyone else believes there's going to be a recession, we're not going to spend more. And if we don't spend more, well, how about that? We just caused a recession. The touchy-feely really matters. And I'm telling you that if the Fed continues to message hopelessness, the credit markets will oblige. They just did. I don't write it to hear myself speak. That doesn't make sense because you don't write to hear yourself speak. I don't write it to see my words on a page. And I don't say it to hear myself speak. Okay, let's talk about an optimistic view and a pessimistic view. Optimistic view. I start with the optimistic view because if I start with the pessimistic view, people tend to not listen anymore. Optimistic view. I've said this to you guys in CML Pro Webinar, like perhaps breaking the system a little, which is what happened. Let's hope it's a little. Maybe it brings down the risk of breaking the system a lot. Just think about that for a second. Maybe 2 people are about to get in a really big fight, fist fight, and it was going to be nasty. Right? And someone throws a punch and they swing and miss and they bludgeon their hand on a fence and it's bloody and open. And this fight didn't really get started yet. And both people are like, well, fuck, I mean, I want to beat your ass, but I mean, that was a kind of mistake. And so like they broke the system a little bit. You got that bloody hand, like, let's call this fight off. It's kind of what happened, right? The Fed didn't get taken to the face of the economy. It got bludgeoned a little bit. Just, like, oh, that's a bloody nose. Like, hey, maybe we'll just call this off. So I said prior that I do not think that a slow disinflation met with continued rising rates would allow for a stable system. I was painfully clear about that, criticized for it. Right? I said, if we're going to go the route that the Fed wants to go, we're going to go in a recession. And not only are we going to go in a recession, we're going to be in a bad recession. There's been a rather fast quantitative tightening shock, I said. Well, there you go. The tightening of bank lending standards, which may deepen further, of course, suggests a coming contraction in business lending. And why would that be? Because look what a big part of our economy regional banks are. They're not SMBs. They're not small and medium size. They're BGs, big and gigantic in terms of their impact on lending. Big and gigantic, 80% of commercial lending, 60% of real estate. So this chart shows in blue year-over-year change in C&I loans. Okay. It's led by the net change of banks tightening. This axis has been reversed, right? So there's more banks tightening going down. You tell me what's going to happen. I just want to be clear why I'm bringing this up. So here's my second learning device, right? One was going to be red font. The other is to show you stuff I just wrote. This is from this webinar. I took a slide from 18 slides ago, and I just put it back. I said, in contrast, riskier entities like regional banks and consumer-related loans could experience reduced money flows and lending. That blue line, that orange line. I said, credit tightening is expected. That's those lines going down. That's this webinar. And I'm on a slide that says maybe this is, I said, this is an optimistic view. Well, maybe this is pessimistic too. If it gets too bad, then we have a bad recession. So it's optimistic if it cools inflation enough such that the Fed can back off and not be hopeless. It's pessimistic if it causes a recession. So it's a muddy middle. JP Morgan, really, really interesting. Just yesterday, I could not believe it. JP Morgan just said that. I'm going to read it word for word. The global expansion, they're talking about economic expansion, is looking even more resilient than expected. I'm going to talk about why. Raising questions about the likelihood of our call for a US recession and global slowdown later this year. Wow. And why is that? Because they think inflation is going to be able to come down fast enough so that the Fed can stop. What did I say was happening? I think we're going to face a rather fast quantitative tightening shock. And this shock happens to coincide with very good timing. It's one thing to be at the slot table or to be playing slots, megabucks, and to win. Hey, that's one thing. It's even better if you bet full max and won the megabucks. You won $14 million. We might have, this is the optimistic view. I'm not saying this is my view. I will tell you my view. I'm going to let you form your opinion first. Optimistic view, pessimistic view, then my opinion. This shock coincides with very good timing, friends. Guys, if we were sitting around and we're like, if we could break the system a little, and maybe it'll stop the system from breaking a lot, and we had to pick a time, it's right now. Now. And why is that? Well, first of all, friends, oil prices in the March CPI report, which is going to come in April, they're going to roll over. So March of 2022 had $120 oil because of the invasion of Ukraine. Oil is $70 right now. That we're replacing that top circle with that bottom circle. That top circle, the war, that's $120 oil, that's going to leave the CPI computation. And what's it going to be replaced with? The lowest number in a year. Well, that's pretty good timing. Second, rents are about to do the same thing. Rents are about to do this. We're about to get these guys out and these guys in. And rents account for 44% of core PCE, or if you prefer, 43% of core CPI. It's a huge, huge deal. Let's take a step back. What am I talking about? Here's how CPI is computed. Red is energy. You can see it going down. This little thing is going to go negative, right? We're replacing 120 with the 65. It's going to be a drag on CPI. I think it could be as much as a 0.7% drag. So what I mean is if everything held constant, I think CPI would go from 6 to 5.3 just because of that. The rest is food. You can see goods inflation is gone. We might start seeing deflation. It's those pesky little services. the green, right? Everything other than services is below 2%. It's those pesky little services, but 44% of those services is rent. So here's how it looks. This dark line is 2%, not dark line. This thick line is 2%. Everything other than services is already below 2% target. It's services that are pushing it above, but those are lagged. So what about those services? 44% are shelter, 56% are non-shelter. One at a time. Shelter. Zillow's rent index, its annual growth, usually leads rent CPI by 6 to 12 months. I'm going to show you what I mean. This yellow line is what the CPI is seeing on rent, right? Last print of CPI, rents were like at not the all-time high, but the cycle high. But rents are crashing in real time, right? Rents are crashing. It's about the reason we say it's about 6 to 12 month lead is because the BLS, the Bureau of Labor Statistics, doesn't actually know exactly when it's going to come. It's been 6 months where we've seen deflation in rents. If we go 6 months from now, from February, we're in August. So it should be at the latest in August. That very big positive number will now be a very big negative number. This is core logic. Okay. Another source of rents, right? So remember, inflation is a measurement of change. The change is negative. Right now, it's super, super positive, right? It's growing. Like it's still CPI is still somewhere here on this. It's about to face this. Okay. So remember 3 things that made this really timely. Oil is going to roll over. That one everyone knows. I guarantee you that. Second, it looks like rents are going to roll over. Third, let's talk about the other services, 56%. They're driven by wages. And that's why, if you're wondering why Powell is so passionate about wanting to get job cuts, it's because if fewer people are working, there are more people in the workforce who are unemployed, then the demand for workers will go down, the supply of workers will go up, and the price of workers will go down, and that's called wages. Over the last 3 months, so again, I'm sharing JP Morgan research, but they put it out, so I'm allowed to do this. Over the last 3 months, average hourly earnings were up 3.6% annualized. Why does that matter? Because Powell just said 3.5% that's where we would be at 2% inflation. So wages not always, wages should grow more than inflation. So we don't want 2% wage growth. About 3.5%, if we have a 2% target CPI, that's where we want it. Well, that's where we are in the last 3 months. And I'll tell you one other thing. The February month-over-month number was the smallest growth in average earnings in a year. It's coming down. And how do we know that? Because I said it in CML Pro. This is the dossier. March 10th, I said, here in the title, wage growth grows the least in a year. This shouldn't be new information to you, but if it is, I don't blame you. I don't read the stuff I pay for either. It's overload. So I'm trying to make it, you're committing time to me on a weekend. That's so gracious of you. I want to make it worth it. And part of the way I'm making it worth it is just telling you what I told you. That's important. So they're going through the whole thing. Okay. This is wage inflation year over year. Don't worry about that rise. That's an artifact of it being 0 last February. So this year over year thing is just because it's replacing this number with this number. You can see what we've got coming out, right? These last 3 months, that's 3.6%. That's what JP Morgan said. All right, so going back, I said we're going to have, optimistic view, perhaps breaking the system a little could bring down the risk of breaking the system a lot. We're going to have a fast quantitative shock, I think it's possible. Tightening shock. We could have, it coincides with very good timing. Also, the Fed forecasts 0.4% GDP growth for 2023. And you think, oh, that's pretty slow GDP growth. Yeah, there's a problem with that. We grew 2.6% in Q4, and the Atlanta Fed has a GDP tracker for Q1, and it's at 3.2%. Well, how are we going to get to 0.4% from 3.2%? Do you realize how large of a recession we'd have to be in? Well, here we go. It means there's a few things. Either the Fed sees a radical recession in the last 3 quarters of 2023. And by the way, that's what the bond market is pricing, right? That futures curve I showed you, it was pricing in number 1. But could it be something else? It could. It could be that that Atlanta Fed is just wrong. Maybe Q1 GDP growth isn't 3.2%. Maybe it's 1% and a 0.4% for the years. Yeah, doesn't mean a huge recession. Or number three, and this is what JP Morgan is starting to get at. Number three, you ready? What if GDP growth is just simply going to be higher than the Fed forecast? What if it's not going to be 0.4%? What if what JP Morgan sees is true? Well, then we're not in a recession. That's the optimistic view. Perhaps breaking the system a little will stop us from breaking the system a lot. Perhaps we're getting a rather fast quantitative tightening shock exactly when we needed it. Oil rolling over, rent rolling over, wage inflation rolling over. GDP growth is holding up better than the Fed forecast. This would be Goldilocks timing. They say the Fed has to thread the needle. There's a saying in the Bible, it is easier for a camel to pass through the eye of a needle than for a rich man to make it into heaven. Well, I don't know about all of that, but this sure feels like the Fed is fitting a camel through the eye of a needle. That's the optimistic view. There's a pessimistic view. And it's going to use alternative data. The US economy is heavily reliant on credit. We are a nation of spenders, and we do it on credit. And given that the banks are likely to prioritize strengthening their balance sheets over extending loans, and now you know why I can say that, to the private sector, we have the makings of a recession. Further, commercial real estate. CRE for short. We haven't really talked about it. I told you I would talk about it on the webinar. Now I'm talking about it. There is $1.5 trillion in commercial real estate maturing in 3 years. For anyone who owns a house, was buying a house, it's the same phenomenon. But imagine you had to redo your mortgage. The rates are way higher. The bulk of the debt is going to get financed. It was financed when base interest rates were zero, and this debt needs to be refinanced. In an environment where rates are going up and values are lower. And why are values lower? Let me show you. This is the vacancy rate in San Francisco. If we were in court, I would say this is Exhibit A. How much is that apartment building, or that, well, it's commercial, yeah, apartment building, the enterprise building, right? That office building. How much is it worth now? How much are you willing to go out on a limb if you're the bank? Hello? Vacancy rates are spiking. Interest rates are higher. $1.5 trillion needs to be refinanced. And remember this? Remember my learning mnemonic? 80% of commercial real estate lending comes from the medium-sized banks. Remember what I said? It's true that they're small and medium-sized banks with regard to assets. These are not small and medium-sized banks when it comes to the impact of the U.S. economy. They really, really matter. That is a snapshot of a slide like 67 ago, right? Same webinar. Let's keep going on the pessimistic view. Some would say there's a reason that every recession in the last 50 years followed a yield inversion, where short-term interest rates are higher than long-term interest rates, which is what is killing the banks. And what happens is that there's an unexpected incident or failure, a shock. It's not because the bond market can create a recession, although what's interesting is they might have to change that part of the textbooks because it might have. But it's because it's a signal. It's a reflection. If you trade options, the implied volatility doesn't predict where the stock is going to go. It's a reflection of the risk of where a stock might go. Every hiking cycle in the last 70 years ends in recession or financial crisis, and it's not going to be different this time. That's what Graham Secker said. He's the chief European equity strategist for Morgan Stanley in London. Morgan Stanley is known to be one of the more bearish banks, and the EU is in a bad place. And we have previously opined on CML Pro Webinars that if the Fed was going to carry through on its rate hikes, remember I said if it's just going to go according to plan, that we saw very high probability of a bad recession. Milton Friedman said it best. Monetary policy works in long and variable lags, and the impact of the first hikes might be hitting the system right now. And if that's the case, uh-oh. This is the pessimistic view. I'm going to show you some charts. This is alternative data, which I'm finally free to do because for some reason, institutions now think Twitter is worth it. I don't know why they think that. It isn't, but thanks, guys. Now all the research I get, I can share. This is from Michael Cancho. He's the chief investment strategist at Piper Sandler. Also, Michael is the top-ranked strategist, Institutional Investor Magazine. He's on Twitter. You can feel free to follow. This is foot traffic in home improvement places like Lowe's, Home Depot, Ace Hardware. It's now below, I want you to think about this. It's below the lows of COVID. Morgan Stanley buckets things in 5 ways for their view on global equities, not just necessarily US. They look, are SPX forward earnings declining? They are. That's S&P 500. Is the yield curve inverted? It is. Is unemployment below average? Below average. It is. We are almost record low unemployment. We were record unemployment last month. The manufacturing PMIs, purchasing managers indexes, which go from a scale from 0 to 100, below 50 is contraction. Manufacturing is contracting and has been contracting. But you already know that because I sent that in CML Pro, right? 40% of banks are tightening lending standards. All 5 are in place today, which is rare, says Morgan Stanley, and then they shared their chart. When none of them happen, that's the return. When one of them happens, bad, or worse, bad. We're in bad. This is the pessimistic view. Commodities have started to behave again. There is a problem. Dr. Copper. Renewable energy? Yeah, we need copper. Copper prices could surge to new all-time high, according to a forecast from Trafigura. Due to Chinese demand and low inventories, here's a chart from Financial Times. This charts global copper stockpiles, how they're getting depleted, and they've added the current demand for 2023. Demand is going to, according to them, is going to outstrip supply. Uh-oh. Here comes inflation. This is the pessimistic view. Tender rejections. This is for trucking. They've collapsed to all-time lows outside of the extremes of COVID. A tender rejection is what measures the pricing power that fleets have in the market. So someone comes to them, Walmart comes to them. Well, Walmart probably owns their own trucks, but let's just pretend they don't. Walmart comes to them and says, hey, we'll pay you $10 if you move all of our stuff. When the price is too low, they get a rejection. Like, nah, don't need it. We got an $11 bid. We got a $12 bid. They're not canceling anything. They just need the business. So that's really good for disinflation or deflation, but it could mean that we're headed to recession. Demand for corrugated boxes. Corrugated boxes are what you would expect they are. They're those cardboard boxes we move in, or the things that your TV comes in. Look at the demand for them. It's below COVID lows. What's going on? This reads, it's a chart. This reads as a full-blown heart attack to the economy. Everything is stopping. Heart attack, kidney failure, it's all happening. It's one chart. This is the pessimistic view. Generally, when people talk about a landing, soft or hard, they're talking about employment. Right before that comes housing. Home prices are reversing lower at a rapid rate. The 3-month annualized change in S&P CoreLogic National Home Price Index was down 5.2%. That last time it was that fast was the great financial crisis. Giving you a little more color. This is the 30-year fixed mortgage rate. This is prices. This is the curve it follows. That's actually January 2023. They're all out here. If they were going to follow this pattern, they're coming down here. I'm not saying they are. This is the pessimistic view. Barclays, one of the least comfortable things Barclays sent me. Not me. They sent to the world. Credit card spending. Uh-oh. Negative. First time since March 2021. All right, how about spreads? Well, the spread between high yield dollar denominated corporate bonds and those on investment grade securities widened to 367 basis points. Why does anybody care about 367 basis points? First of all, because in finance, we're a little bit, we like numbers that repeat. We're superstitious. So that level has been sufficient to trigger a recession. Uh-oh, we just hit the level. Stanley Druckenmiller, what did he say? You know, man, I don't really know about this pessimistic or optimistic thing. This is the hardest environment I've ever encountered to try and have any confidence in a forecast 6 to 12 months ahead. I agree. But I don't know. Since 1987, the only longer streak of negative net negative sentiment towards the market surrounded the financial crisis. So these are the months in a row of negative net sentiment. So either this is pessimistic because we got more to go, or it's optimistic because it peaks and then we get out of a recession. I don't know. So, okay, before I go, now you go to yourself. I gave you an optimistic view. I gave you a pessimistic view. I explained to you what happened with the banking crisis. I explained why it could be idiosyncratic. I explained why it might not be idiosyncratic. I showed you the flow of credit, the flow of funds. I showed you alternative data. I showed you data on what comprises the very basis of CPI and core CPI, not just services, each one taken down, the trends in each of them. I went as specific as to say, look what happened in March 2022 that's going to come out when we get March of 2023 out of that 12-month reading. You, to yourself, before I say anything, I want you to say to yourself, because I don't want to make your mind up for you. Is it optimistic? Is it pessimistic? Or is it I don't really know? And if it's always I don't really know, so nobody knows for sure. I'm saying, would you say you're 70% sure of one or the other? Are you 70% sure it's pessimistic, 70% sure it's optimistic? If you're neither of those, then you would say I don't know. So you, right now, to yourself, everyone, go ahead. Is this good news, bad news, or I don't know? Well, since you're paying for my opinion, I guess it's time I shared that, isn't it? I said that we believe combining the impending credit tightening from the financial system shocks, that's the banks, with the base effects of oil, now down 50%, and rents rolling over, that the optimistic views that CPI will print with a 3 handle by August. So by the report in September, CPI will be 3.XX. Optimistic, that means the inflation time bomb has been diffused. And if I think inflation is the only thing that matters, then I think it's about to be party time. Also, matters is spelled with 2 T's. I know that. So what I wrote here is inflation is the only thing that matters. Here's the problem with my forecast. Remember I told you guys, I said, I want you to decide. No one's ever sure about anything, but if you're 70% pessimistic, then you have a pretty good view that, things aren't going to be so great. You're going to hold off for a while. If you're 70% optimistic, then you get a pretty good view. You get 7%, you're going to start buying. And if you don't have that, then you don't really know. Well, when we build a framework, an economic framework, a forecasting framework, the intention is to have a base case where you have a substantial majority of the probability density inside that base case. That's just really fancy measure theory to say, I don't know, I feel like 70% certain. You never feel certain in finance, so just stop. But the thing is, you want a base case where there's at least more than 50% confidence. And then we work with the 2 tails. Is it like, there's kurtosis? Is it symmetric? Is there more downside risk to upside risk? Okay, well, whatever. But if you can't do that, if you can't say I feel like there's a strong, the probability density inside my base case is strong, well, then you have to say my framework might not be sufficient nor efficacious enough to make extrapolations for tactical trading. I can't market time with this information. I could market time during COVID. I wasn't sure, but you guys remember it came April and I said, I'm going balls long. I don't know right now. To be fully transparent right now, our framework for modeling the intermediate term economic outcome is not necessarily sufficient to make extrapolations for tactical decisions. And in truth, I'm not sure anyone's model is, no matter how much confidence they speak with. So you decide. Sitting out is okay. Investing is okay. Mark Dow just said, in the market, you more often than not don't have the luxury of being confident. You have to go with likely, even if you're not highly confident in that likelihood. What do you think is likely? Here's where I get a free pass, because I have an intermediate term. I have a take beyond the intermediate term. You ready? You've heard this before. At CML Pro, our focus is to prioritize long-term growth over short-term gains, regardless of the economic cycle, and to continue to identify companies that continue to innovate, expand, and create value for shareholders. That's why we have 4 new top picks, 2 of which are active. And that's why 14 out of 16 top picks, including Big Commerce, which was dropped, it was dropped up for the year, are up. Datadog is actually unchanged, and Ondas is down. The one top pick that is the least top picky. 4 new top picks, 2 are active. The performance, top pick performance, is crushing the S&P and NASDAQ this year, not last year. Not the second half of 2021. No, it sucked. I'm not saying all is forgiven. I'm saying if you're not enjoying Q1 of 2023, get out of the market, because this is unusually good. This is COVID good. You're not supposed to have 85% of picks up, because that's definitely not happening in NASDAQ. This is a 1-second celebration for Q1. Now we move on. Okay. Yeah. Move on. Q1 has been massively good. I hope you felt that. If you don't, then I don't think you're ready to be invested in stocks. All right, let's do a quick review of inflation measures, and then we'll get to the thing that I think most of you are interested in, which is ChatGPT and the 37 or 38 companies that I've chosen that I think you could look at. And there's probably more. First, when inflation is not our worry, or inflation is not the only thing that matters, we won't be doing this, but we do have to do it now. This is CPI and core CPI. Look at the trends. PPI and core PPI. This is the producer's price index. This leads inflation. That will matter in a second. We just got core PCE and PCE, right? Everything's going down. The question I've always had, I said it in August or July of last year, even though I continue to be trolled for it, I said, we've peaked. Maybe I was a month early. Doesn't matter. We've peaked. And I peaked. We've peaked. We're right. I was right. It's just not coming down fast enough. What would I look at for these? I would look at these 3. Core PCE, core PPI, and CPI. The reason I say CPI is because that's actually by law what the Fed has to look at. And I say core CPI, core PCE, because core PCE is what the Fed looks at to try to predict CPI. And finally, I look at core PPI because core PPI leads, right? What wholesalers pay leads what retail gets, what the retail gets charged. And it's starting to collapse. All these readings were like so. PPI is collapsing. It was supposed to be 5.2% for core. It came in at 4.4. It was a radically lower number. That will come into play. And you say, when? Well, here you go. PPI, let's look at the cores. PPI picked here. Let's go up with our mouse. Core actually peaked over here. That's a good 5 or 6 months. We have this disinflationary trend coming, so it's already in. We don't have to wait. But when are we going to get this boom down? Maybe 6 months. That's why I'm saying look out for that August report. Rents will roll over. Wages will roll over. Oil will roll over. Wholesale prices will roll over. I'm targeting that. Okay. Now let's talk about my view of ChatGPT. It's pretty simple. Here's the opportunity. I'm going to tell you the optimistic view and the pessimistic view too, right? But I'm much more certain about, I mean, what is it? A likelihood? I feel like there's a far higher likelihood of the optimistic view than the pessimistic view, but I have to share both. Here's the opportunity. There will be much more code created. Of that, I can promise you. Whether it's going to be production code or used code, I don't know, but there's going to be a whole hell of a lot more code created. It's faster and it's easier. And because there's going to be more code created, it's going to have to sit somewhere. And that means there's going to be more infrastructure needed. Well, if there's more code created and therefore we need more infrastructure, guess what we're going to need more of? Semiconductors and tooling. And if we're going to have more code and more infrastructure is going to be used, and there's going to be more semiconductors, well, then the platform part of the infrastructure is going to be needed. Well, if we're going to have a larger infrastructure and more code and more platform, well, then we have to have more infrastructure observability, right? Infrastructures will grow and become more complex. And if we have more code created and larger infrastructures and more semiconductors and more platform that's needed and more infrastructure observability needed, we're going to need more application performance monitoring. And if we have more code created and more infrastructure and more semiconductors and more platform and more infrastructure observability, more APM, we're going to need more source code management. And if all these things happen, well, it's inevitable. We're going to have my single favorite thematic in all of investing, data, more data. And if we have more data and we have larger infrastructures and more applications, we're going to need to secure it. And if we have all of this new code and new infrastructure and this platform, and we're monitoring it and more data is created and there's more security, well, then we're going to have more products. And if we're going to have more products, we got to sell the products. And we sell the products through advertising. That's what I think is coming. I've seen hype and I've seen overhype in my life. Friends, I was working at what is now known as UBS, Payne Weber, in 1998. And I saw the internet bubble, saw the good part, saw the bad part. This is my 25th year. End of this year will be 25 years. I've seen a lot of it. I don't think this is hype. That doesn't mean I'm right. I just don't think it is. I'm not the gospel. I'm just an opinion. You guys can probably hear a very loud, wow. It's a loud car blasting their music. It says, in spring, we live in suburbia because we're like that. It's rude. Okay. So in less than 2 years, companies that are not using ChatGPT or some large language model, LLM apparatus similar to, right? Whatever, doesn't have to be ChatGPT. That doesn't have to be the winner. I think they could be completely run over by current competitors and new entrants. I said could. It's in red because I said could. I didn't say would. During COVID, I said would. During COVID, I said things are going to go up. I didn't say that. I said they could. There is a risk. So I'm going to give you a pretty dire risk. Okay? It's a bad one. I want you guys to know this is a bad one. So I want you to really consider this. It's a really bad one. And it's why there was an open letter sent by Elon Musk at Kedera, or at Alia, to basically to Congress to say, you got to stop this. Okay, here it is. Let's say we have 5 software companies that compete today in an area. Let's say it's infrastructure observability, because that's one of the things I pointed out. So it's Datadog, Dynatrace, Splunk, a couple of private companies. There's more than, obviously there's more than 5, there's many, but and it's semi-competitive because, capitalism. But they're yielding really high rents, right? They're making a lot of money. Datadog's a monster. Okay, let's say something hypothetical. I am an analyst of record for Datadog, so when I talk about the company, it's incumbent upon me to let you know that before I talk about the company, I am not formally changing my estimates for revenue. I'm not formally changing my estimates for EPS. I'm not formally changing my estimates for price. This is a hypothetical, contrived example. Here's where ChatGPT goes wrong. You got these 5 software companies. They're all doing their thing. They're making a lot of money. How about in 2 to 5 years? We get 10 people anywhere, and they create the same thing. 10 different ways using ChatGPT with the new plugins and text. So what they do is they go, right? They'll go to Datadog's sales page, hey, Datadog's really will do this. And they copy and paste it. They go to Splunk, copy and paste. Dynatrace, copy and paste. Copy and paste, just copy and paste. They go to ChatGPT, connect it through API, glue code's written, appropriate for the hardware. And they say, please write me code in AWS in this language that does this, copy, paste. Every single thing you can find. Connect it to ChatGPT, it's done. It's done. No overhead, no legacy tech. Maybe people do this and don't even seek profits. They have no employees. Maybe they make it free. Or maybe they just compete on price with thousands of fewer employees. Right? Instead of charging $1 million a year, they're like, we'll charge you $100 a year. Maybe it's just one person in a home office. And then do that on every part of enterprise software. I didn't pick on observability. It's just the easiest one to say out loud, but it can be something else. Well, then the whole fucking thing comes down. And that's in 2 to 5 years. What about in 5 years? That's millions of people doing the same thing in every part of software and every non-real world service. Right? Okay, that's a really dark view, but it's unfair to the pessimistic view to be catastrophic. So I'm going to give you a dark view that isn't catastrophic. You don't have to say, oh, come on, dude. So there's still a dark view that's less catastrophic. Perhaps the largest enterprises will simply turn back to build rather than buy. So during this tech boom, companies just said, we're going to buy our enterprise software. They're fully managed services. We're just going to buy it off the shelf. Let's go. There was a time in technology where companies actually built their own software, not for resale. They built their own software. So I think realistically, the decision to build rather than to buy is the risk we are most focused on right now. That's the risk I really focus on. I'm not so focused on the, it's all gone. It might be. I want to see if enterprises are starting to build rather than buy. Now, is there a reason for them is there a reason to buy rather than build? Of course, there's a reason to buy. Fully managed service, upgrades done, everything's taken care of for you. But yes, it's possible with ChatGPT or some LLM. Few resources. Maybe it's say, you know what? We're spending $35 million a year on enterprise software. I don't want to do that anymore. So why do we think there's greater opportunity than there is risk? First, open source software is available now for almost everything that's occurring in the cloud, from observability to APM and almost everything in between. But enterprises prefer managed solutions. They prefer that the updates are done for them, that patches are made, security is updated, that things get upgraded, that they don't have to do anything. So here we go.